Hello and welcome to FIRSTtalk, where we simplify super. My name's Andy and today I'm joined by Lou and Jason, and we're going to be talking about how do I build up my superannuation for retirement, or what is commonly referred to voluntary contributions, additional contributions. So Jason, first of all, what type of additional voluntary contributions can members make?
Yeah, so there are two types of contributions that you can make in addition to what your employer's putting in. So typically we classify them as before tax contributions or after tax contributions.
And sorry, technically what are those before and after tax contributions known as?
Yeah, so your before tax contributions are known as your concessional contributions because they're concessionally taxed, and your after tax contributions are known as non-concessional contributions. There's no other tax concession on it as you've already paid tax on those funds effectively.
Okay, so concessional tax means the contribution goes in and there's additional tax that's applied to it, but it's at 15%.
Yep.
And if it goes in what we call as non-concessional or after-tax contributions, then they don't get taxed at all. They go in tax-free around there. So let's start off with those before-tax contributions. Lou, there's something called a salary sacrifice. Can you explain to us what is that and how does it work?
Yes, certainly. So that's basically an agreement between you and your employer where you sacrifice a certain part of your wage and put it into your superannuation.
So what's the benefit of it? Why would I want to be putting money into my super before income tax is applied?
Well, purely the taxation side of it. So essentially, money that gets taxed through payroll is taxed at your margin rate, as compared to when you salary sacrifice, as you mentioned before, it's only taxed at 15%.
All right, so if I'm earning a certain amount of money, I'm in this higher tax bracket, which is around about 30% in average terms, suddenly I can reduce the tax that I'm paying on that money and hence salary sacrifice.
Absolutely.
So how do I go about arranging this and what do I need to do?
Yeah, so certainly that's just an arrangement between you and your employer. So it's just a matter of reaching out to your employer and deciding on an amount, whether that's by yourself or through your accountant. You decide an amount, speak to your employer and they'll make that happen to you on a regular basis.
So once I've set this up, am I locked in?
No, not at all. So essentially it's really an agreement between you two. If you find that after 6 months you decide that you can't afford that anymore, or in fact you go the other way and say, look, I'm doing this easy, I can put in more, it's just a matter of reaching out to your employer and saying, look, I want to change this or I want to stop it, and they'll make that happen for you.
Right. So it's very flexible. I'm in control of it.
Absolutely.
So I decide on how much goes in. And to your point, I can increase it, decrease it, stop it, start it again. It's just up to me about how I have to manage it.
That's right.
Around that. So, okay, that's fine if I'm willing to make that contribution, salary sacrifice into my super, but what if I can't afford it? You know, what I take home at the end of the day, I need that money to meet my living expenses, especially in this current environment, but I've got some money in the bank account. So Jason, what's my options there?
Yeah, so you can make what's called a personal tax deductible contribution. So it effectively is the same as doing a salary sacrifice. It's just using the money that you might have accumulated in the bank. You know, you might be self-employed, you might be working casual, so you don't know on a week-to-week basis what you're going to earn, or you might have just come into a little bit of money. So what you effectively do is you put in the lump sum from your bank account and use this magic form, as I call it, the notice of intent to claim, and that effectively just transverses it into a salary sacrifice type contribution.
Okay, so instead of making it on a regular basis, I can put it as a lump sum and still achieve the same tax benefit from it. And you made the reference to this notice of intention. What's the important thing about that form?
Yeah, so once you put the money in, it just goes in and it'll go in as an after-tax contribution. So this notice of intent form basically notifies a super fund, please tax this at 15%. And then when you do your tax return, the super fund will push through that this amount has been salary sacrificed effectively, and it'll reduce your taxable income. So you get a nice, healthy little tax return, which is always handy.
So the key there is make the contribution for the 30th of June, then put in this notice of intention, then do your tax return. And you've got to do it in that sequence of events. Otherwise, the tax department goes, I'm sorry, you can't claim that around that. Okay, so that's what we call concessional contributions. And with concessional contributions, there's a cap on how much you can put in. It is made up of those salary sacrifice contributions we spoke about. It could also include an additional personal tax deductible contribution, but the other thing to remember, it includes your employer contribution, or what is commonly known as the superannuation guarantee. Those three contributions combined cannot exceed the cap in the financial year. So, okay, that's fine. But again, what if I came into some money and I've got a large amount of savings? You know, maybe I came into an inheritance, or, you know, I won a little bit of money on lotto or something of that nature. What if I want to put that into my super, as a lump sum? What do we call that, and how do I do it?
Yeah, so that's an after-tax contribution typically, or your non-concessional contribution. So that cap is higher. Generally, it's 4 times whatever the concessional cap is, so it's much more. And it's money that you've theoretically already paid tax on. So, it might be you've sold a home or you've received an inheritance. Those funds are being taxed at some point. Okay, so the government doesn't want to double tax you. I'm sure they'd like to, but they won't in this case. So you can put in that. It's a much higher amount, and it goes in tax-free as well, so there's no additional tax to pay.
All right, great. So, but what if I'm, we spoke about before this salary sacrifice, and we said you had to be on a higher wage, but what if I'm on a lower wage and I want to put some extra contributions into it? So, Lou, can I do that, and how do I do that?
Yeah, you can. So essentially you may qualify for what's called the government co-contribution. Now that's an automated process. So what you might find, as you mentioned before, if you're on a lower tax bracket or lower earnings bracket, essentially you can contribute a contribution into your super fund, post-tax or after-tax. When you do your tax return, the tax office will assess what your earnings are, and if you do qualify, technically speaking, they will transfer a co-contribution straight into your super account. Now the way that normally works is that for every $1 that you put in, they can potentially put in 50 cents up to a limit.
Up to a limit,
Yes.
yeah. And that maximum amount the government will put in is $500 for
Correct.
every $1 that you put
Absolutely.
in. So in theory, if you put $1,000 in, the maximum that the government will give you is $500. If you happen to put $2,000 in, the government's still only going to give you $500.
And it's important to note too that you don't actually have to do anything for that. As I mentioned before, you put the contribution in, you do your tax return. If you qualify, the tax office will automatically pay that contribution, that co-contribution straight into your super account. Yep.
Brilliant. All right, so we talked about these additional voluntary contributions. There's 2 options, before and after tax, around them in that regards. But if we go back to those before tax, and I spoke about this cap, but there's an exemption. There's always an exemption. What is that exemption, Jason?
Yeah, so the government a few years ago introduced what's called a carry forward provision. So effectively what they're saying is, okay, you've got a cap every year. The first thing is you've got to have less than $500,000 in your super to be eligible for this. But effectively over the last 5 years, if you haven't utilised that cap, it'll carry forward and you can potentially go above and beyond whatever the standard cap is for this financial year.
Yeah. Okay. And if you're interested in that, we do have a separate video just on that carry forward rule. So by all means, we do recommend that you look at that video. Okay. So, but if we come back to these after-tax contributions, what if I got a larger amount? Maybe I come into some inheritance. I've got this larger amount of money that I want to put into my superannuation. So, Lou, can I? And if so, how? Or what should I think about if I'm going to wanted to do that?
Yeah, absolutely, Andy. So what you find is that in that situation, you can utilise what's called the bring forward rule. And what that enables you to do is actually put in more than what you normally can. So Jason mentioned before that you've got a yearly cap that you can't go over, but by utilising bring forward rule, what you can do is if you have a significant amount, you can actually bring forward the next 2 years. So you're bringing forward 3 years worth, but what that then means is that after you've put in 3 years worth, you then can't contribute for the next couple of years. And most importantly, what you've got to realise is that with these contributions that you put into your super, once you put them in, it's locked into at least retirement or your preservation age. So think long and hard before you go putting in large lump sums into your super.
Very good point, very good point. So I can do these before and after tax contributions. Yes, there's a cap on it, but there's some exemptions. There's something called the carry forward rule for the before tax contributions, and there's something called the bring forward rule for those after tax contributions. There are also other types of contributions that you can do as well. There's things called the downsizer, and again, we've got an episode that covers that off. And there's something called a spouse contribution as well. And we have a publication on our website that explains that in more details as well. But what we've described before is the real key ones and the most common ones in those regards. So if you're putting in or deciding to put in additional contributions, naturally you're going to be wondering about, well, where does this take me to and how does this actually build up my superannuation? So we do have something called a retirement health check that's available to you, and that will give you a projection about building up your superannuation over the remaining period of your working career, and then how does that convert into a regular income in your retirement years as well. But before you even get there, you might be thinking about, well, what type of contribution is best for me? Do I do it before or an after? There's actually a calculator on our website that you can use, and if you put in the amount that you're willing to put into your super, it will come back and tell you which is the better option for you in that regards. Again, there's lots of information on our website that explain all these contributions in further detail, but at the end of the day, sometimes you just want to talk to somebody, and we do have our contact centre and we have our local coordinators that may be in your local area that you can speak to. Even at the end of the day, after getting all this information, you're still a little bit unclear as in what should I do and what is the best option for me. That's where the financial advice team of myself, Jason, Daniela and Richard come into play, and we can give you that advice and that guidance in that area. So please have a look at the additional videos that we've got available underneath FIRSTtalk and our website for further information. But until next time, take care.